All right. All right. So thanks again for jumping on. Give a quick introduction of who we are. We are a UPC fund, or Upgrade Partners Capital. We focus on helping high income professionals like yourself be able to invest in multifamily apartment buildings for the purpose of, right, you're busy building your businesses, busy growing your careers, being with your family. And we think that multifamily investing is a great way to be able to get out of, your career if you choose that, or to at least add extra income so that you have more time to do what you want to do, right? So, all right. So what we're going to discuss today. And one thing that I'll mention too is with investing, we invest through a fund structure where we pool capital together, and we take that pool of capital and we go and invest in large apartment buildings. And by doing so, we're able to get better returns than if you were to go invest directly by yourself. Okay. So today what we're going to focus on is why we chose multifamily as a asset class to invest in. And then we will do some quick analysis, teach you how to do like a quick analysis when opportunities are presented to you. Okay. So first of all, why, what is multifamily, right? Kim, I think you had said that you've invested a little bit in multifamily, right? Or like smaller multifamily deals?
No, I have rental houses.
Yeah, rental houses. Okay.
Yeah.
So the main difference, right, between multifamily and single family is multifamily, right, is classified as housing where it's, 2 to 4 to 5 plus 100+ unit apartment complexes where people, it's just big buildings where people reside, right? And a cool fact that we brought up here is that this is from another capital raiser. They're called Ashcroft Capital. And the quote that they stated on multifamily was, the fact that multifamily has remained a top pick for investors is really not a surprise, because here in the US, we're still over 1 million homes behind in meeting the current consumer demand for affordable places to live. And that has been the case for about 20 years, right? So that just goes to show that there's still a demand. So the supply and demand, supply is still low, demand is very high. The growth rate is much more than, the declining rate of our cities here in the US. So why multifamily over other assets or investment vehicles, right? And we're actually going to talk about multifamily, the why of multifamily here in a minute. We're going to look at some other asset classes that you could invest in, right? Or that you maybe have. BJ and Kim, we'll keep this somewhat, everybody involved. So Kim, you've done single family, right? What are other asset classes or investment vehicles have you guys invested in up to now?
So my 401k,
Okay.
which is in the stock market.
Okay. And what kind of returns are you getting on that?
I it's all in the 401k, so I just kind of just let it ride and don't pay attention to it.
That makes sense. You just
It's
let
more
it
than it
roll.
used to be. That's the big thing. It's more than it used to be.
Nice. Good deal. What about you, BJ? Have you invested in other assets or investment vehicles?
So I'm the same way. I had a 401k with a company that I used to work with, and same thing. I let it ride. I never really paid attention. right now I am currently investing in my own company,
Yep.
just trying to build it.
I think I missed that last part, BJ, but I think what you were saying is that you're investing.
Yeah, I got to go around one more. I got to go around one more mountain, and
then you'll be out.
yeah, I got to get around one more mountain before I get good service. I'm sorry, guys.
All good. I'll keep going. One thing I want to note for you guys is, did you both know that if you currently have a 401k that you can self-direct that 401k and invest it in like multifamily or real estate?
I did not know that.
Yep, you can do that. Granted, the returns that you make have to go back into the 401k. You can't take it personally, but that's how you grow that 401k.
Yes, that sounds interesting.
Yep. And we can
that
talk
money right now is just sitting.
Yep. So that's, that's actually, we'll do that on another educational series, and that's how we like to help people build wealth as well, is like, what other accesses to capital do you have that you may not consider that you can use for apartments? 401ks, Roth IRAs, like all of those are part of that you can self-direct into, and there's a lot of like tax benefits to use in a 401k.
Do you guys have a company that you work with for the self-directed for our IRAs or whatever?
Yeah, there's a company here in Utah. I'm trying to remember their name, but there's another company in Rexburg called KKOS, that they're a group of lawyers and accountants. I'm pretty sure that they can be, what are they called? Custodians.
Oh, okay.
If that's something of interest for
And then
both
do you
of
end up getting like a,
go ahead, Kim.
do you end up getting like a K-1 statement?
Yes, you will both.
Okay.
If you invest with
Yeah.
a 401k cash, yeah, investing with us, you will get a K1 for your taxes.
So this investing the IRAs would be a good topic for another
Yes.
another session.
Yep, that's the plan. One of the next ones, and maybe we'll do it as one of the next one, like the next one after this, is talking about all the sources of capital that you have access to that you hadn't considered that you could use, right? Like whole life insurance being another one, right? If you have a whole life insurance policy, you can leverage that as well. Okay, so I'm just making a couple notes here for so the other asset classes that one could invest in is like debt, right? In what we call the capital stack, when we buy apartment buildings, the very first thing that you have to get is debt, right? So whether you're doing single family, flips, land, right? Debt gives you like 10 to 12% return for a very short period of time, right? And you'll find with me that our team has a very like abundant mindset. So we want to help you guys be able to diversify your portfolio as much as you want to help grow that wealth. Like debt could be another good investment vehicle, because with apartments, you invest and you expect that money to be locked up for the next 3, 5, 7 years, right? With consistent cash flow, with appreciation benefits, depreciation benefits, kind of giving you some of the benefits now. But with debt, you're getting a high interest and a short period of time, right? So that money can double very quickly, right? But you don't get all the other benefits that you would. You don't get a K1 with debt. You get charged short-term capital gains when you do that, right? There's many pros and cons to both. Okay. Other assets could be single-family rentals, right? Like Kim has. The difference between that, right? A single family is you've got one tenant typically for each house. If that tenant leaves, then you're 100% vacant, like you've got to cover the entire cost of the debt, right? With apartments, we can go like 30 to 40% vacant before we get to break even. So on a 100-unit deal, like we could get to 60, 70 units occupied and still be breaking even, right? On a single family house too, if you have a roof you have to replace, you've got to do that on each individual house, where even if it's a fourplex, you're replacing one roof, right? So there's more economies of scale essentially. But single family rentals, Kim, you could, if you want to speak about the pros of single family, I haven't done many of them. I actually have not ever done a single family transaction. But I think they're probably a lot easier to buy and sell and kind of do what you want with them.
Well,
I give any
I don't
commentary
really
there.
have that much experience with it. I mean, I have them, and you get nightmare tenants that you don't know it's a nightmare until they've moved out, and then you discover.
Yep.
So, and then you have to deal with it.
Yep. It's true. All right. So next thing we'll go over is commercial, which is like triple net, office, retail, right? That those investments can be very volatile depending on the market. Land, right? If you invest in land, you should expect a very long-term hold without any cash flow. Right? I'm not going to say that any of these are bad. They're not bad whatsoever. It just depends on what your investing criteria is and what you need right now, right, for your investing. Development can be, very beneficial. So we're actually looking at a couple development deals right now in opportunity zones. So development, right? There's no cash flow for the first couple of years, but then there's a lot of appreciation, and you're buying a brand new, or you're building a brand new deal that should last many years, right? So we talked kind of about stocks and bonds, high yield interest accounts. You're getting 4 or 5% on a good year, right? Like right now. But there's no typical upside, and it's probably the most secure until the market changes. And then another investment vehicle that not many people talk about is like venture capital, private equity, going and buying businesses and flipping businesses, right? That can be a great investment. If you pick a good company to work for or work with. Typically the venture capital, when you're going out and buying businesses, it's usually higher risk, much higher risk, higher volatility. But if one hits, you sometimes can get the Amazons or eBays or Uber Eats, of the world's, and it can be very profitable. Okay. Any questions on anything we've gone over so far?
Not from me.
So when you were referring to the debt part, that's just, will you go over that one more time so I can understand it?
Yep. So debt, there are companies out there who will lend debt at high interest, right? So say I wanted to go and fix and flip a single family house, right? So fix and flippers deal with debt. Debt, when I mean debt, it's more like hard money loans, where, so if I have a house that I wanted to go flip and I needed some debt, it would cost me probably like 2 or 3 points, 12 to 14%. So if I needed $500,000, right, at 4%, that's 20K. And at 12%, that's 60K a year, right? That's high interest, short-term debt. So if you were to go and invest 50K, 100K into a debt fund, if you will, because there are debt funds out there that are like, say, mortgage backed, or first lien position backed, right? So let's take your house, for example, BJ. I think you said that your house right now is free and clear. Is that correct?
No,
No,
that's
yeah.
the only thing I have financed right now.
Oh, that's right. Okay, so that lender on your house right now is what's called first position, right? If you ever defaulted on your loan, they would be the very first people to get their money back, right?
Okay.
And so that's what we call like high. So when people do like these hard money loans at like the 3 points and 12% or 12 to 14%, right? They're in first lien position. So if the seller, if the owner of the property ever got defaulted on, then they would get their money back first. So you as an investor, if you were to invest in that, you could expect, 10 to 12% on your money in typically 3 months, 6 months to 12-month period, right? But the only thing you're getting out of that investment is that 10, 12% return on your money, right?
Yeah, and then I get that money, capital gains. I have to pay everything that I
Yep.
earn, right?
And it's short-term capital gains, which puts you at the highest like tax bracket, right?
Okay.
But like if you say you had 100K, right, 100,000 times 12%, it's 12K a year. That's $1,000 a month. Say it's over 6 months, you get 6K, right? But that's like all the upside that you're gonna get on it. And then you got to figure out, hey, where am I gonna put that 100K, 106K now, into the next deal, right? If you put in 100K into an apartment deal, you're going to make another 100K on top of that roughly in 5 years, in a 5-year period, right? Which comes out to be, what is that? It's like 20K a year. But your cash flow will sit around 6% a year, right? So it's lower cash flow each month, each distribution, and then the big pop is on the back end. You just have to wait 5 years versus you're getting a much greater pop, from the very beginning. Does that make sense?
Okay. It does.
Yep. So there's a lot of like debt funds right now where debt is super expensive, right? There's a lot of people that are lending debt right now to go and like buy land to start developments. There's not a lot of it for like multifamily unless they're getting a severely discounted price, right? They'll go in and buy it and it's quick too, right? You can move very quickly with debt. So any other questions on that, or is that?
Nope, that was good. Thank you.
Yep. All right, so the next thing we'll talk about is like why multifamily apartments, and we kind of talked about it a second ago, but with what we're seeing in our worlds in the US with renters and buyers, like we know that debt right now is through the roof, right? Like to go get, like for me, if I was to go get a loan right now, it would be like what, high sixes, low sevens probably. Right, so it's super expensive. So with that in mind, these are some statistics that we found on renting versus buying. So right now, Americans are preferring to rent. There's 5 to 6 million new renter households that will be created in the next 10 years, right? If you think about it, that COVID era, right? Call them the COVID babies, right? In the next 15 years, there's going to be a massive shortage of rentals just because so many babies were born during that time, similar to the baby boomers, right? So only half of all renters said they anticipated becoming homeowners in the next 5 years. Less than a third of renters cited inability to obtain a mortgage, as we just talked about, as a reason for not becoming homeowners in the future. 43% of all renters don't want to own, and 39% enjoy renting, right? It's a convenience to rent, right? Like I've been renting for the last 3-4 years, and I've enjoyed it because I get ultimate flexibility, right? I can move wherever I want to in a short amount of time, if I'm not ready to, settle down. The other thing too, that why people are moving into apartments is because apartments are now providing, amenities that you would, like, if you owned your home, you'd have to, go to your own swimming pool, or you'd have to go to a gym, right, in town. It's just the modern conveniences of everything being right there where you live. There's sometimes apartment buildings have, coffee shops on the ground level, and they've got pools and gyms and, movie theaters. And it's crazy. Some of these apartment buildings, to keep tenants feeling like, hey, this is home, right? So that's more of like the younger age, but baby boomers are also looking to rent, right? 75 million baby boomers right now are looking to downsize, right? They're looking to urban apartments for convenient services and easy access to amenities. So it's similar story with baby boomers, and since baby boomers don't need like the big, 2,000-3,000 square foot house anymore, because their stairs are just too much cleaning, they want to be closer to their kids. So a lot of kids, right, are moving inner city, so they're moving to apartments to be closer to their kids, right? So you've got a huge amount of like new renters that are coming up right now. All right, any questions on that, or are we good with that?
I'm good.
Okay,
Keep going.
perfect. Okay, well, I want to quiz you guys just a little bit. So when we think about like the financial benefits of investing in real estate or multifamily specifically over other asset classes, for you guys, like, what are the main benefits that you've seen thus far as to like why you would want to get into it? And I've got a list of things, so I'm curious to know, like, what's most important to you from what you've learned thus far.
So for me, I want to have money working for me instead of just sitting around. That's the big thing for me right now.
Yeah.
To
Great.
eventually grow it to where I don't have to be.
Did I lose you, BJ? Last thing I heard you say was build it till, and then I lost you.
Just build up to where I don't have to be working every day is the goal.
Yep. Yeah, that's great. What about for you, Kim?
Well, I'm interested in keeping the cash flow from the rental houses, but getting away from being the landlord myself.
Yeah. Yeah, that's a great one. Cool. So a couple other reasons why investors like to invest in multifamily is, one, it's super scalable, right? As Kim, you mentioned, it's fully passive and it creates consistent cash flow, right? It's cash flow that, similar to like what you're wanting, BJ, it can be consistent to where it's like, I can count on this, right? So then I know like, hey, I've got this much coming in every single month, and it can increase, right? Even until it sells, right? There's appreciation benefits, right? I was telling somebody a story the other day, like I I've got an apartment building that I'm selling right now. We bought it for 2 million 3 years ago, and we're selling it today for 6.5. Right? Yes, we did a ton of work to it, but there's also, you know, with the market the way it is, we bought it at the right time, and because of the market growing, the appreciation has helped get us to that $6.5 million number, so that as we sell it, our investors will gain even a greater profit. Right? So even if there wasn't any cash flow on it, like similar to like a development, you have that appreciation where you can multiply your money. Okay. There's the depreciation benefits, like we talked about, getting a K1, being able to use the depreciation to write off passive gains, which will ultimately lower your tax burden. Okay. Another one is wealth acceleration. Right? So wealth acceleration, similarly to, you know, BJ, what you're wanting to do, be able to replace your existing income and be able to, because like say we have a deal that you sell it and you put in 100K and you get 60 to 70 back from the sale, you roll that forward, right? And there's pre-tax dollars that are associated with that. If you do a 1031, get more depreciation, right? There's the multiplication effect of being able to continue building that. Another one is it's really low risk and it can be recession resistant. Right? Everybody, as we talked about a second ago, is going to need a place to live. And it's low risk because of like what we do. We work with sponsors and operators who have amazing track records, right? They have a far less likely chance of losing than, you know, a guy off the street who's only been doing this a year or two, right? So there's so many risk factors that we are mitigating in order to make sure that it is as low risk of an investment and as high of a return as possible. And the last one is leverage. It goes back to debt. Debt can either make you or it can break you. You know, a lot of deals that are coming available right now is because people bought stupid debt 2 or 3 years ago, not expecting this would happen, right? So if you have good leverage, you know, right now good leverage is, you know, 50 to 60% of apartments, right? Even if the market continued to crash even more, like we're just gonna hold, right? A mentor taught me this. He said in 08 and 09, the only people who lost money were the people who put themselves in a bad position and had to sell, right? The people who made money were the guys who bought right and just sat there and waited for the market to grow, right? Okay. Any other thoughts on that? If not, I'm going to move into the next part, which is doing some analysis. Kim, did you have a question? I saw you had your thing on off mute.
No, I didn't have a question. I just forgot to put it back on mute.
Oh, all good. Okay.
Hopefully I didn't make too much background noise. Sorry.
No, you didn't at all. You didn't at all. All right. One thing I want to do is see, BJ, are you able to see the screen now?
I can see you. Is that what you're referring to?
Yeah, if you can see me, I want to share my screen so that I want to share a couple examples of what we're talking about as we're looking at doing analysis. This is honestly like one of my favorite parts of what I do, is being able to share how to analyze deals. Let's see. Just got to find the right, let's see. Okay, so you guys can see my screen. All right. So one of the first things that we look at when we're looking at a deal, so here's a deal that I've been underwriting. I don't think I'm going to win this deal. They want too much money, but it's 88 units here in Ogden, Utah. I believe it's already under contract, but either way, we will use it as a great example. So the first thing that I'm going to look at when we're looking at deals, or for you guys specifically, when I send you an offering memorandum, right, which is essentially this, you're going to look at a few things. Okay. First thing that you're going to look at, and what I would look at personally, is I'm going to look at the current expenses, income and expenses. So right now, this property, 88 units in Ogden, they want to sell it for $20 million. The annual rental income is about 1.4 million. So once you take in vacancy, lost lease, bad debt, all of that fun stuff, and add other income, we're about $1.3 million in gross operating income. Okay. So then the next thing we'll look at is expenses. And the main thing, it can take a long time to look at each expense category. The first thing I'm going to look at is, what is my expense ratio? Right here, it shows that the expense ratio is 30%, which for Utah, and since I know this market really well, 30% is actually really good. There's been deals that we've looked at in the past where the expense ratios are 40%, 50%. And that's where the value add to the deal is being able to go in and decrease that expense ratio, right? Let's see. So then the next thing that we will look at here is, when I look at this deal, the first thing I'm going to do after seeing this is like, okay, they want 20 million. This is my income. This is my expense. This is my net operating income. So you'll hear this being referred to as NOI, net operating income, right? It's essentially your net. What you will do to figure out your cap rate is you take the 927, 623 and divide it by $20 million. So this property is selling for I think they even have it here. It's a 4.6 cap rate. Let's see, right there, current cap rate. And now you guys may be wondering, what is a cap rate, right? So a cap rate, to quickly tell you, is if you were to buy this property for cash, I'm going to take $20 million out of my pocket, buy this deal. That means that you will be making a 4.6% return on your money. Okay. But it also gives a good indicator of how expensive this deal is, right? Because it's a function of the NOI against the purchase price. So if this was a cap rate of 2%, that means that this deal is making very little money, or it's super expensive, right? If you go buy something right now in New York or say California, like you're probably going to be buying 2 and 3 cap rate deals, super expensive. The deals that we're looking at right now, we want to be buying them at a 6.5 cap rate. And the reason because of that is, if we've got to go like this deal, I would have to go and get brand new debt on this deal. And if I'm buying it at a say at this 4.6%, but I'm paying 7% to debt, right? I'm kind of in a deficit there, right? Because I'm paying such a higher interest rate than what I'm making. And that's where leverage comes in, because when you leverage it, that's when your cash flow, your cash on cash return goes up significantly, right? So you're going from a 4.6 to like a 13. It's like they got like a 10%, return. So this deal you know, if you were to look at this really quickly and you didn't see anything else, you'd say, okay, 4.6 cap rate. The market cap rate is 6.5. This deal is way too freaking expensive, right? So that's where we go and say, okay, we're going to take this existing NOI. The one thing too is that cap rates are not the end all be all of the deal. Cap rates are merely a function of the income against the purchase price. Like this deal had probably $200 a unit that we could get on it, but it wasn't enough of an increase to justify that low of a purchase price. Like there's a deal that I bought in Tremont that had practically a 0 cap rate just because nobody was paying anything. It was a freeloader building. But because of what I could go and do with it, gave me the ability, right, to go and increase that income. And my debt was like super low, it was like 4.25. So cap rate is not the end all be all, but it is a very good primary function to look at. Now, the next thing that we're going to, like, really quick, does that make sense? What we look at income, expenses, NOI to purchase price to figure out the cap rate of a deal? I know it's kind of a lot right off the bat. Okay. I'll keep going on this unless somebody had something.
No, that makes sense to me.
Okay. So when I look at that deal and I say, okay, that's an expensive cap rate, let's look at the rent roll and what's possible. So you can see here, and Kim, I'll send this all to you as well so that you can look at it if you're not able to see it now. As a good example, when we look at these deals, we get what's called a rent roll and a T12. So a rent roll is going to show you all of the tenants, every single tenant. It's going to show you when their lease started, when their lease ended, how much they're paying for rent now, if there's any like other income items that they're paying for, like pet rent, late fees, internet. There's a dozens of other income items that could be categorized on here. And so when I come on here, I like to really do a deep dissection of the rent roll because it tells a story. Okay. So when I got this rent roll, I came in and I like to color code it and figure out, okay, so the biggest value here, as we can see, is there are 52 units that are 2-bed, 1.5 bath. These are about 1,300 square foot units, so they're really big. The lowest rent that they're charging right now is $1,000, but the highest rent is $1,495, with the average being $1,260. So the story there and what that tells me is that I have the ability to increase my rents from 1,000 to 1,500, but knowing that the average is $1,260, I've got about a $230 increase that I can make, right? Give or take, right? So why that's important. If we were to take, and this is something that like really boggled my mind when I first learned it. You guys can see my screen. If we take, okay, we're going to take this $230 a month increase that we can get. And this is without doing any renovations. This is bumping them to market, what they're currently getting in rents. Okay. $230 times 88 units times 12 months. Let's see. Yep. 12 months. That gives us $242,880 in increase. Okay. So if I bought this deal and I increased everything to market, and then what we'll do is what we're looking for is if I go and do that, how much will it increase the value of my property? if we take a 6% cap rate, because, right, that's a market rate, even if we did 0.65, which is a market cap rate, that tells me that I can get a $3.7 million increase in value on the property by just increasing the rents $230. Right? That's pretty freaking amazing. Right? That is really good.
So you assumed all 88 units were gonna bump.
Yep. Yep. So if I took, I'll show you, and I've done this math. So let's see, equal to the average of, whoops, this. Okay, 1294. We do it over here. So, right, the high on average is 1529 for all 88 units, and the average is 1294, right? So if we take that, you're $235. Right? So per the example,
Okay, that makes sense.
we could get about a $235 increase on every single unit, right? And that would increase the value by 3.7 million. Okay. And then if we were able to do renovations, say we did, $10,000 to $15,000 a unit. Say we were able to get, so let's say our renovations per unit cost us 12,500, equal to that times 88. That's, what is that, 1.1 million. Okay. Say we're able to get $150 bump on top of the 235. What we're going to do, and this is the reason I'm sharing this with you, is when we look at these offering memorandums for other deals, I want to know what is their return on investment if they're going to go and renovate every single unit, right? In my world, if it's less than 12 to 15%, it's not worth doing. It's worth increasing them to market and waiting till you can either get your cost down or you can increase that renovation premium higher, right? So if we did $150 times 88 units, that's 13,200. Let's do times 12. So the way we calculate ROI is you take your return over your investment. Okay, so we're going to take that 15.8 divided by 1.8. It's a 14.4% return. I would probably renovate all of those units to get that $150 bump. Right? So now, if we took, instead of $230, we did 230 plus 150, puts us at 480. We just increased the value of the property by $8 million. Okay. That's over like.
Is that something that you typically do? And when you go in and buy one, if you see this, do you typically go in and do this?
Like, what do you mean? Like, do we do the actual function of like this kind of analysis or like?
No. Do you typically go in and do the renovation to get that 7.7 million extra?
Yes, we do. Usually it's over the next couple of years, right? And it really, so like right now, a lot of what we're doing is we're doing renovations upon turn instead of like forcing renovations or forcing people out to do renovations, just because costs are still high and that renovation premium is lower. We're able to get a lot more money just from doing, putting people to market than we are putting a lot of money into it. So it really depends. It really will depend on the market, how much it's going to cost to turn that unit, and how much of a return you can get for turning that unit, renovating it, right? So if we were to come in and do, say, go into the 3-bedroom right? And it cost us 17,500, and I'm only getting $150 bump. It's a 10% return. Like, there's no reason to renovate that unit, right? We would just bump it to market rate.
Okay.
So, but it really depends on where we are at in that market cycle with cost and return. And kind of what the demand, I'd say what the demand is too. Because if you can go in and do, say, a $5,000 renovation, with a, you know, maybe so a $5,000 renovation would probably get you new flooring, painted cabinets, a paint job, and like a light fixture upgrade, right? Very minimal cosmetic, right? You'd probably get you like a $75 increase. That's 18%. Do that all day long, right? Like a 15K plus is new flooring, new cabinets, new counters, you know, probably a brand new bathroom as well. You know, all the new appliances, like an appliance package. So it just really depends too on the market, right? But we want to make sure we're getting a great enough return on that renovation, that it makes sense to do it. Okay. The other thing that I really like to look at is the leases. The leases tell a great story. So I color code these as well. When I was first analyzing this deal, out of the 88 units, I found, hey, 63 of the 88 units are going month to month by the end of January. So month to month, meaning, right, that their lease expires. So I can go in and put together my business plan right away, right? I can kick all 63 people out if I want and renovate their unit. Or I can go and say, hey, you're on a month to month. You can re-sign a new lease at $200 plus where you're currently at, right? So having leases go month to month gives us ultimate flexibility to go and implement our business plan right away, right? So it's a great day for an operator when there's a lot of, you know, units coming vacant. So you can see here that pretty much by the time we would have bought this, had we gone under contract in December, 72 plus 3 vacant, 75 units out of the 88, I could have gone in and done whatever I wanted to, right? Does this make sense with the rent roll and how we use it?
Yes.
It's a little bit more nitty gritty than what you'll ever probably do, but it helps to know because I'll put it in like the reports and whatnot when we're looking at a deal, right? It's like, hey, these guys have a lot of room to increase value because of rent increases, as well as the leases are coming end of the lease so that they have the ability to do what they want with them, right? Let's see. The other thing that we'll look at really quickly, and I know that we're kind of getting to the, oh geez, it's already 5 o'clock. I apologize. I lost track of time. We'll look at what's called a T12. I'll show you quickly what a T12 looks like. Let's see if I can find. I don't know if I have. Let's see. I have an O. No, they don't have it. A T12 shows. Let me just pull this back up. So a T12 will show a trailing 12 month. So right now, where we are in February, it'll show me all income, all expenses from last January or March, from March to now, because we want to see the trends. Okay, is income going up? Is income going down? Oh, I know exactly where I can show you what that looks like. Let's see, potential, Sunset Springs, come on. Where's all my stuff? Ridgecrest. Okay, here's an example of a T12. Okay, so you can see that it shows pretty much from October 2021 to September 2022, right? Even that first line, let's look at just like the total revenue, total income, right? 247,000, 251, 255, right? We look at this and quickly I'm gonna say, okay, what's the highest and what's the lowest and why? Right. So in July of 2022, they had $295,000 of income when the average is 254. So it's like, why? Like, where's that $40,000 deficit, right? Or surplus, sorry, not deficit, right? A lot of it is they had $7,000 of termination fees, which increased, that number. So without going into further detail, we would that's how we analyze the T12 is look at the trend, the trailing 12 months and seeing what's different here. Okay. And where's the opportunity to improve? So when we look at value add, it's can we increase rents to market? Can we do renovations to increase to a renovation premium? Can we decrease expenses? Right? What can we do to make this property significantly more efficient? Okay. Let's see. How much more time do you guys have? Because I have like one last thing, and that would probably be it.
I'm okay to keep going.
BJ, you in good shape?
Yeah. Yep. I'm good.
Okay. So the last thing that I want to share is so like the deal that we are raising on right now, and I think both of you have seen the deal. I'm gonna pull it up really quick. When we look at risks, so that's the next thing that I want to talk about is risk, right? When we look at deals, the very first thing that we're going to look at is the sponsor. Okay. So if we look at the sponsor of this deal that we're investing with and we're raising on right now, right, our criteria is that we want to invest with individuals who have had at least 5 successful exits, meaning they've bought and sold at least 5 deals, that they have a presence in their existing market. They've got a track record of, with those successful exits, their returns, have they beat projections, right? I think that, and I'll be very transparent with you guys, right? I have a deal that I am selling right now. That deal I told you about, the 2 million we bought it for, and the 6.5 we're selling it for. That deal did not go great because the team that we put together, I thought had far more experience than they actually did. I didn't do the best research and vetting of what they said they had done. And so we had many challenges in the last 3 years, right? To where us as investors had to jump in and take over, right? We didn't vet that sponsor good enough, right? And that's me being vulnerable. That's like how I've learned, hey, that's a big risk. That's for me now, a number one red flag is we're going to verify what they've actually done and talk to other investors about their track record, right? So for me, that's huge because for the last 3 years, I've been dealing with this and trying to take over control of an incompetent team that was different than what we thought, right? So that's a huge risk to any investment is the sponsor. One of my favorite sayings around that with a sponsor is, if you have the very best team in the slums of Chicago, you will make money on that deal. because you have the right team that has the right skill set, right? If you have the wrong team in the very best deal in the best location, it doesn't freaking matter. Okay. So vetting the sponsor is hugely important. And, on another educational series, that may be something that we go into depth too, is like, what are the things that we do track outside of track record, exits, like we look at background checks, like there's a whole laundry list of things that we look at. Okay. We look at, the story of the deal. There's a lot of operators out there who are just buying a deal to get the acquisition fee, right? To feed another deal. So the story, we want to make sure that when we're buying these deals that we're not highly leveraged. Debt along with like who the sponsor is. Because with the sponsor, you're betting on the horse, right? With debt, it's like, is he comfortably situated in the saddle, right? Because I think if a jockey doesn't have the right saddle, he might not do very well, right? Being a guy who rides horses myself, used to ranching, if you got a saddle with too short of stirrups and that guy goes to bucking, man, you're getting Superman off the front and you're in trouble. Right? So with an apartment deal, you could liken the debt to, the saddle, right? Do you have the debt that's going to help the sponsor, help the deal be successful? Okay. When we look at the deal itself, similarly to like what we just talked about, right? What's the business plan, right? Is there great enough upside, or are we just, buying it because we have a 1031, or, we look at, what's the vacancy rate in this area? What's the and that goes into market actually as well, is, the debt, or sorry, not the debt, the vacancy rate, the, what is it? I just forgot the term. Let me just show you a report really quick that pretty much talks about, okay, so population, income, the median household income, right? Can they pay for what increases we're going to do, right? Because we don't want income to be over 30 to 40% of what they're paying in rent, right? Which is, you guys may say like, freak, that's 30 to 40%. That's a lot already, right? Of a person's income, right? We look at, the race and ethnicity of a market, their education, the marital status. Like when we get into deals, like we know who our tenants are, through and through, right? It's just like for a business, right? BJ, I'm sure you guys have like a specific avatar of contractor you work with to get more welding jobs, right? You're very specific on who you target, right? And Kim, I know you have a paint gallery, right? And so you have a very specific target clientele that you target to come to your art gallery. With tenants right now, we're targeting like newly married students that have very small families. So similar to the renter base that we talked about earlier, right? New renters, newly married, 1 to 2 kids, or baby boomers that just need like a ground level apartment with very few stairs, right? And maybe something smaller, right? That's like my apartments here that we're selling for 6.5, exactly who our tenant base is, and that's who we target, right? When we think of the market specifically, we will look at what are state metrics, what are city metrics, and what are even neighborhood metrics. Because you can be, a great state to invest in right now is, say, Ohio, like this deal. Ohio is a great state. If you invested in Cincinnati, Cincinnati's a great city. But if you go to the MSA of Cincinnati and invest in Dayton, for example, Ohio, which is a smaller city, but if you invest in like Dayton, man, Dayton is one of the worst places in Ohio to invest. I've got experience there. So like you can buy deals for 20,000 a unit there. It's crazy, right? And then knowing the neighborhood, right? The beautiful thing about this deal right here is we've got a lot of blue collar and white collar workers, but you've got this big, huge industrial park over here. Those are going to be your tenants, right? You can't see this whole area. Let me actually see if I can see I believe that there is a high level or a overview. There we go, location overview, right? So Knollwood Crossing right here. So what's closest is a whole bunch of retail and restaurants, right? So you've got a lot of blue collar and white collar people that are going to be leaving there because they have access to, shopping and food, right? Let's see. Those are some of the risks. Do you guys have any other questions about other risks that you'd want to discuss?
Not right now.
Okay. Kim, anything on your end?
No, you did a good job for today.
Okay. Last thing I'll say is that if you guys want to jump on, we have our investor webinar on Thursday at 3:00 Mountain Time, where we are going to have those sponsors of that Ohio deal jump on and present that deal to our investor base. Whether you're interested in investing now or not, I think it'd be a great opportunity to jump on and learn. Because they'll talk about stuff that I haven't talked about, and you'll be able to ask questions at the end. So if nothing else, it'll be a great educational opportunity. So I think BJ, you're already registered for that, I believe, right?
Yep.
So Kim, I'll send you the link as well if you'd like to check it out.
Yeah, send me an invitation.
Okay, I'll do that. And yeah, I appreciate your guys' time. Is there one thing I like to ask is for future webinar series, what you would like me to discuss? I've got down here talking about using 401ks, IRAs, to be able to reinvest can be one, right? Is there any other topics that you guys would like me to discuss?
I think we'll learn about some topics that we have questions on when we attend this thing coming up.
Yep. Okay. Well, I'll see you both on there. Sure appreciate you jumping on and your time. You both have my phone number and email. So any questions in the meantime, feel free to shoot me a text or give me a call.
All right. Thanks, Joe.
You got
Thanks
it.
so much, Joe.
Of course.
Nice to be on the meeting with you, BJ.
You too.
Sure appreciate you guys. Talk to you soon.
Okay,
Yep.
bye.
Bye.
Bye-bye.